Well, first, the Fed, ECB tonight, BOJ tomorrow. Joining us to make sense of all the big data drops this week and, of course, what it means in terms of trading FX, Nick Twidale from FP Markets. Nick, good afternoon. I suppose we can call it afternoon.
It's afternoon somewhere.
Yeah, all right. Look, that was a pretty muted market reaction to the Fed's hike.
It was disappointing, really. I think from a trader's perspective, we just didn't really see too much. Not really in currencies. Yields dropped a bit, but they've just been coming up in the US anyway for the last couple of days. And I think we've got we're going back to the old style central banks now. There's a bit of fence sitting saying, well, we've got to wait for data. So it feels like the Fed are getting themselves to a place where they want to be. They're starting to see inflation coming down. Jobs are still a bit of a concern. But now they're probably quite rightly saying, look, we need to see more numbers before we can make a call on what's going to happen. The market's still sort of leaning to the dovish side, I think. I think they're only like a 22% chance of priced in of a September hike. I'm probably a bit more hawkish than that. I think we really need to see sort of the bigger inflation numbers coming down. But we move on to the ECB, I think. It's like the Fed's really been a bit of a damp squib for us for this session in particular, and we'll see where we go. But US stocks are holding up really well if you look at what we're really seeing from the Fed. And probably Asian markets, we're seeing a bit of divergence as well. But for us, really, probably a relatively quiet session ahead until we hit the ECB, and then it could be off to the races.
All right, so what could happen tonight with the ECB? Because, of course, we saw the PMI sort of softening in terms of manufacturing. So definitely seeing slowing in the economy there. So is it more... Is the language associated with it more up in the air with the ECB?
That's definitely it. And I think it's the same for all three central banks this week. And the language was, let's be quite frank, disappointing from the Fed. There's hoping from a trader's perspective that we get a little bit more clear forward guidance from the ECB. We could see another disappointing meeting, to be honest, where there's a balanced view that comes out. But Europe's in a different situation to the Fed. I mean, we're looking over there at the moment. There's pressures on Europe. China's one of the pressures. Like we're seeing a downturn from China will hit European markets harder than it will hit the US. That's something they will be aware of. We are seeing inflation coming off a bit as well. And there's some other geopolitical risks. And also, I mean, things like we've got to take into some of the micro factors like wildfires in Greece. You've got a pretty heavy sort of summer going on in Europe at the moment as well. They could be factors, probably not foremost on the ECB's mind, but something they have to take into account, that a faster slowing in that economy could see them be more dovish than we got from the Fed, for instance.
Okay, so what would you like to see happen with the euro?
I'd like to, from a trader's perspective, I'd love to see something solid from them saying like, okay, we feel we've done enough. We're seeing inflation coming down. I'd like to see them be a bit more dovish. I think that will support the European economy a little bit more. The sort of head on my shoulder, that's my heart, the head on my shoulders says we're probably going to see a fairly balanced statement from the ECB, and we won't see too much. But I think once we digest everything, I'm probably leaning to be a bit more bearish on the euro dollar, certainly against the dollar and probably on some of the crosses. It is going to come down to what they say. But if we get, as we heard from the Fed, and the central banks seem to all be singing from the same hymn sheet at the moment. They've been leaning to the hawkish side of things. The market's not really paying too much attention. We tend to be a little bit more dovish, and that's a bit more optimistic on the stock side of things. But there's some interesting trading opportunities, I think, if we get some divergence from the status quo.
Okay, so that divergence, even between, say, the US and Australia, I mean, what do you see as really, I mean, there's the euro. What are we looking at here in terms of the lines?
I threw this in because that topside resistance has gone all the way back to those highs, way back, 2009 when we were up at like the 160 levels. That's quite strong. It's coming in around 116 at the moment. I think if you follow that dovish, bearish sort of scenario I was looking at, you're probably going to be looking on a longer term to trade to the downside, either back up against that 116 level, which is quite far away, or a break of that sort of stronger sort of support line. And then I think if we move over to the hourly chart, that comes in a lot nicer, and it's a lot more of a tradable opportunity for the intraday, intra-week. There you go, that support coming in around 109. That stretches back, and it's a good trend line support. It's got a few touches on there as well. So I think that's something I'm targeting. It does depend on the rhetoric we get from the ECB.
Okay. But U.S. dollar, I mean, is it your base case that we will see an easing in the U.S. dollar as we hit likely peak rates there?
I think so, yes, but I'm moving the other way because I think for currency traders we're going to see divergence from central banks, and therefore that interest rate differential, which has been driving markets so quickly, is my feeling on the euro is that we're going to see rates possibly come off harder there than we will from the US, and that's certainly that US peak has dominated moves for the last couple of months. But I think there may be a change in that side of things, especially in the euro. But I think.
But what about the Aussie?
Well, I was just about to say, I think this is where the cross currencies are going to come in a little bit, like even more potentially for bigger moves, because something like the Aussie, you know, we're actually tracking along okay. Yes, we saw a decrease in inflation yesterday, but a nice one. I still think we see 25 basis points next month from at the next meeting from the RBA. I think they've been very consistent, and I think this is where a divergence for the longer term currency traders are actually going to present some really good opportunities. So Euro Aussie is one I'm looking at, and sterling's another one that comes in as well, because that split now, the Brexit split's helping currency traders. We always see volatility in sterling. So I think there's opportunities coming up in currencies.
Okay, so there's cable, and but just back to the Aussie, because also China, like we now have potentially a little bit of support coming in from the China stimulus story, right?
Yeah, so I think that's it sort of fits in with the Euro Aussie story I'm talking about. If we do get a slightly more dovish ECB, we get stimulus from China. Australia, we're hoping for a very nice soft landing. That sort of scenario could see Euro Aussie come off fairly hard.
So what are the main drivers of the pound?
So I think the pound's in another very sticky situation. Having just come back from the UK, inflation's still rife, and we're starting to.
And people are still spending.
And people are still spending.
Crazy.
It's you know, I really did that micro research by going to the pubs on several occasions, and they're spending like there's no tomorrow. And it's from.
What's up with that though? Like, you know, you must have been talking to friends and family about.
I have, and there's just this sort of. Not complacency, but just acceptance. It's like, well, if you want to go out, you've got to spend. And I really noticed it over there, and people are sort of saying, oh, Europe's a bit cheaper now as well. So it's flying a bit over there, and I think, like a lot of places, jobs need to really come off before that gets hit. And I think that's what, behind the scenes, because it's not very political to say that for most of the central banks, is they need to see a bit of a cathartic move in the job market for people to feel a bit of pain and for that inflation to come down. Until we see that, I think across the board there's still going to be this sort of hawkish leaning from central banks.
So interesting, because I still think, it's just personal view, that we're dealing with the aftermath of the COVID pandemic. You know, we're still dealing with labour hoarding. You know,
we are, and free money.
Yeah.
So that's still what's affecting markets, and I think we kind of ignore it, but this is the fallout from everything that happened over COVID.